Today is all about teamwork and how different financial professionals can work as a team. So we've got a team here today, part of the team anyway. We've got Brian here from Equitable Bank, and we've got April from RBC. And between the three of us, we'll kind of be helping people understand. I think there's a fair bit of expertise in the room already, so maybe other people can also chime in, but just kind of understanding how to support physicians in their kind of long-term financial success. So we'll head it off with April.
So let me introduce myself again. My name is April. I'm from RBC. I'm a British manager at the commercial market and specialize in healthcare. So I help my clients, mostly doctors, dentists, veterinarians, and also optometrists, and also some other healthcare-related clients. I work in the bank in the banking industry, personal and business, so about 7 years total. Right, so today I want to share, just go back here to a little bit about how do banks or RBC specifically finance, how raise funds and finance for doctors and healthcare clients, and what kind of program we have. And in general, I think this might apply to other banks too, but this is what RBC do to support our healthcare clients. And we do have special programs, financing program, banking program for our healthcare clients. And there are different physicians, right? So the ones who actually cover under our specialized healthcare program includes doctors, dentists, including the specialists. They're from the Royal College members, so they're specialists. The vets, specialists, optometrists. These are the four main client groups that are qualified under our healthcare specialized program. However, you can also see that we also work with pharmacists and chiropractors and physios and other wellness practitioners. Because a lot of times you might see these practitioners work with a medical doctor, they open pharmacies, or they open a wellness center, they work together. We also trying to extend our support to these practitioners and try to help them in the commercial space to raise funds and to finance their practice and any financing needs they have. So here just saying that RBC, we support the healthcare professionals since they're a student and all the way they're learning the internship and all the way when they're practice owners, even when they retire. Right? So they're starting up their own practice, first one, later on expanding, more locations, and later on they might buy clinics or even sell at their retirement. So the whole life cycle, we are there to support the healthcare clients. Okay, so now let's get into what is the financing through at the banks. So usually there are many different ways to raise funds and for different purposes. Right? Usually when you see looking at raising funds, we look at long-term or short-term. Right? For long-term, for the practitioners, buying a practice, that's one purpose why they need to raise funds. Building our practice from scratch is another one. And later on, they might want to also purchase into real estate. So why they want to buy real estate, why they want to buy an office, they want to open the clinic in, so that's what we call owner-occupied real estate. Or they might just simply want to invest into rental property and to rent it out to a tenant. Right? So when they're looking at these opportunities, looking at these projects, these are usually long-term financing they're looking at, and we will help them through term loans, usually for doing the practice and buying real estate, and leasing. We'll go into more in detail in these two here, more related to the practice build out and purchase. And for real estate, there are many ways to raise funds. Term loan is a common way when at the bank, just raise funds when you buy and give you a loan, just like mortgage, right? Give you a loan, and you close and you have your place. Depends on what the property is. We also and also how large the loan and the money you need. we also, not even commercial team, we also work with a commercial mortgages team, which usually deals with larger projects and say multi-resident properties. If you want to invest, usually it's investment properties they're looking at, or commercial property or a huge retail space. Right? Commercial mortgages team are usually the one that we will work with. Or if you want to just invest in a condo unit, right, then our mortgage specialist partner will usually do a residential mortgage. Right? So these are the longer term ways to raise funds. Right? Short terms, then we're looking into when you're operating your own business, then we might need to buy supplies, pay employees, all those day-to-day expenses, right? So these are the short-term financing we do through a operating line or a credit card or commercial cards. Right? So these are the operating side of the financing. And if you guys have any question, you can stop me anytime and ask. Yeah. Right. So this is the overview of what banks and or RBC would do in terms of financing, raising funds for our clients, especially healthcare clients. This one I will go into a little bit more detail on what RBC is offering. Right? Like I said, we oftentimes will look at people helping a client to start their practice or buying into existing practice or buying real estate. Right? For all these situations, we try to provide 100% financing for our healthcare clients, doctors, dentists, and other healthcare clients. This is up to 100% financing, of course, subject to if the cash flow supports, right? And usually we finance it based on either historical cash flows, because if you already have existing practice, you want to buy into a space to move into, we look at your historical. If you're starting a completely new, starts from scratch practice, we look at projections. That means we have to work with an accountant and see what your projected next 3 years your financial will look like, and we use that to put in a calculation and see how much we can finance for you. Aiming for 100%, of course, aiming for. Right? Yeah, so that's the what we call loan to value is how much the loan will be. And depends on the situation. Usually real estate, we can amortize the loan over 25 years. This is different from, say, you're doing a residential mortgage, usually 30 years, like personal. But for commercial, usually 25 years is what we see most often. For the practice build out, usually that means you're doing renovation of the space and also buying equipment. You're building out a practice, or you're buying an existing practice through share purchase. These ones we do over 12 years of amortization, usually like that. Mm-hmm. And we can include a up to 24 months interest-only period for the loan. So that's already included in 25 years and 12 years. Why the interest-only period is important? It's for a lot of new startups. It is at the beginning you might not have the client and the patients right away. Right? You need time to build it up. You need to do marketing, and it takes a couple years or sometimes faster, but then it takes years to build up your patient base to actually grow your business, right? So for that year, we provided up to 24 months, it means 2 years interest-only period. At this time, you only need to worry about the interest portion, but not repaying the loan. So once you start it, the principal payment plus the interest is much larger than just the interest, right? But of course, if some dentists some clients, they don't need it, then you don't have to take the interest-only period. Because when you think about it, interest-only period, that means you're paying more interest because you're not repaying your loan yet for that 1 year or 2 years. Right? So if you don't need it, then don't need to take it. Right? You don't need to apply for it. So we can try, but usually based on the client's situation, the doctor's situation, we give out the advice. Right? Why do we need it? Why do we not need it? We will advise, we suggest you need it, suggest you don't take it. Right? And of course, final decision based on our client, but this is what we strategically say and give them advice on that. For leasehold improvement data is talking about the building out the practice, so the renovation of it and also the buying the equipment. We can also do up to 100% financing and also the 12-year amortization, including the interest-only period. So that's for that. We offer competitive preferred rates for doctors and dentists. Variable and fixed rate are available, right? And usually variable, I can tell you guys, is usually prime minus a quarter. So right now obviously prime's at 4.95. So minus a quarter is 4.7. This is variable term. A lot of clients right now, when I talk to them about rates, they ask about fixed rate because they don't know. Maybe the rates are going back up, right? Some people predict even before the most recent announcement, they're thinking, oh, should I lock in the rate now because the rate might be going back. Some people are saying going back up, but we hear different. We don't know. We never know where the rates will be, right? So this time we can advise the client only based on what we hear, what we know. Yeah. And still, most of my clients and my team's clients, they're choosing variable rate because it gives them the flexibility to pay down the principal amount anytime without penalty. So this is very different from the personal mortgages. Even the variable rate is usually short term, but could be long term, long variable, the whole time is open term. A lot of doctors, they will accumulate cash pretty fast if they're doing good in the business. So when they have the cash, they want to pay down the loan faster. So variable rate open term gives them flexibility anytime, no penalty. So that's a good thing. Yeah.
Can I ask you something?
Yeah.
So you have up there about buying practices, and you talked a little bit about cash flow justifying the loans that you're willing to provide. Say you've got a practice already, and you've got a target practice that you want to purchase. When you do the loans, do you include the cash flow from the new business in those loans?
So you said you already have a practice and buy into another one. So for that situation, we will so like what qualify based on what, right? We will look at the target practice financial and see how profitable, how is it good. Is it good? And also at the same time we look into we might also in that situation we might also ask for a projection. Why? Because if you already have a practice, you're working here maybe full-time, part-time, and when you have another practice, that means you will divide your time to the new practice. Then how would that change this practice cash flow, right? Is it the existing doctors continue to stay there and everything stays the same, or what will be the change? So any change might change how the cash flow, how the revenue or income will be. Yeah. So depends on the situation. Of course, we look at the existing practice, target practice's financial. We also look at if there's a lot of change, then probably a projection, make it reasonable, will be needed. Yeah, because we want to know what it's going forward will look like.
Okay.
Yeah.
So the primary limiting factor would be the scalability of your current practice and the target practice, probably.
We look at both, right? Yeah. So if you have existing, maybe this existing may or may not need to provide guarantee to the new, right? All depends, right? Yeah. So if it's a very successful practice, we may not need that. But if say, maybe cash flow is lacking, then we will suggest adding this is very technical. Then it's like structuring the loan using your existing practice cash flow to support the new one, right? So this is also I will talk about in a little bit later on is how different ways to structure to do that. Because for owner, even if you're buying into a space, I say buying into a space, you can do equity takeout. Let's say if you already own a space and you need some cash, then we can refinance. We call it equity takeout from your existing building or the property you already own, and then to equity takeout using your corporate financial cash flow to take out funds. So that's another way to raise funds. Using your existing property.
Thank you.
We usually co here. I think later on maybe Carl will talk more about when the structures and taxation. But usually what we see is the real estate is purchased and held under the holding company, and we use the operating company's cash flow to qualify. And then the loan usually is under holding company. But the leasehold improvement or the share purchase, practice purchase loan are usually under the holding company. And if you have both company holding and OpCo, we usually do take cost guarantee. So the company cost guaranteeing each other. Okay. So make sure all the cash flow within the same under same umbrella. Okay.
Quick question.
Yes.
So for the RBC loan or business loan, do you guys always require the personal guarantee as well, or it's just optional for the
Usually
loan?
will require personal guarantee because when we think about it as doctors, they are the key person of the business. Without a doctor, there's no one else.
And then GSA as well too, right?
GSA, GSA is the General Security Registration. So it's having RBC to be the first rank. So no matter which bank you go, they will require the first rank. Usually if you take out a loan, right? So no matter which bank, not just RBC requiring GSA. But guarantee here, personal guarantee here, because we put in we also factor into the doctor's salary into our calculation, because usually doctors take out dividend. So that's a cash outflow from the corporation. But this one's actually could be captured back in, because the doctor, that's the salary they take, the compensation they take, so we put it back in. So this is not just an outflow going somewhere else, leaving the company. It's still part of the supporting. Okay. Next one here. So for leasing, I will just quickly go over it. Here, when I mentioned the financing for leasehold improvement, usually GST tax are not be financed through the loan, but with our department leasing financing, we can include the GST in. So we have specialized equipment financing leasing specialist, Paul, which is a colleague. If you guys have any interest into connecting with him, he knows more about that. But then these things are also available for renovations of leasehold improvement and equipment purchase. So going back to the financing part here, it's more about investment properties. So a lot of doctors, when they mature or they have accumulated certain wealth, they want to invest the property and to generate more wealth, right? We can also help the client to do financing to finance the purchase of investment properties, and how much the loan and then the amortization and also the loan to value depends on the property type and the location where it's located. So if it's in Vancouver, large population, then loan to value would be higher usually. If it's in some remote area or the property is we would consider special use, then the loan to value usually is lower. Right? So we try to, for rental property, usually we have to use rental income to qualify, because after all, it's a rental property. That's the cash flow generated is rental income. So we use that first to qualify. And if the client says, I actually want more, what do we do? Then that's what I just talked about. We can use the corporate to cash flow to do financing, either through just using cash flow, just use the corporate cash flow to do a cash flow term loan, or if the corporate already own existing property, we can do refinancing. That will refinance more than just the cash flow term loan.
Does this apply to commercial property only, or commercial and residential?
Usually it's commercial, but then for residential, we will see where the situation is. We might also be able to do it. So I think a lot of residential properties, we try to refer back to our mortgage specialist partners, because after all, it's a residential property. And for that, if they purchase it under personal HOCO, then usually it's our mortgage specialist colleague would do it, and they can offer personal mortgage rate instead of commercial. Because when you compare really, personal rates are usually lower than commercial rate, no matter what, when you really compare. A little bit, right? It depends on which situation. So if the client can qualify under personal, then they will go with the personal HOCO with the mortgage specialist. And this morning I'll have a team meeting. I have a colleague on the island. One of the doctors, they purchased a commercial property as a rental, and because of the size, because the properties have the size, we refer them to our commercial mortgage team that I mentioned before. they did that, and they weren't able to do 100% financing or up to 80%. But our colleague in my team, they use refinance of the existing building that the doctor already owned and make it 100%. So after all, it's 100% financing. We have to structure a different way, work with different teams, combine together. It is what the doctor wants. So yeah, so there's not only me working on this, and when there's needs, we work with our partnering with our obviously different other partners to do it. So this is the financing part. And again, the rental property, 25 years amortization because it's real estate. And for the cash flow term loan that I talk about, just using the operating company's cash flow to take our loan, that the amortization will be a bit lower. Usually it's 5 years to 7 years. If it's related to the real estate, maybe I can ask for exception to go for maybe 10 years a bit lower, but it won't be 25 for cash flow term loan. And for cash flow term loan, that means using the cash flow from the operating company anytime. If the doctor wants to buy equipment, that we can do up to 12 years still, right? And it's also cash flow term loan. Or the client, sometimes I have clients say, I just want to borrow money to do certain investment. So if that's the case, we can do a cash flow term loan, but amortization again shorter will be the 5 years. We also did cash flow term loan for client who want to purchase critical illness insurance. So I think there's some different program that they want to buy critical illness insurance, but they can make one lump sum payment for the premium and buy it. That's done to finish buying the critical illness insurance, and we can do cash flow term loan to finance that premium for them. So I have a few clients that did that. Yeah. I think lastly I want to share just a little bit is other than doing the financing, banking part, we also offer beyond banking services and such as to help our doctors to manage the practice more efficiently. Software, ClearDent is for dental practice software. Maneris is our the payment processing services that we partner with them. We have discounts for our healthcare clients and RBC clients. And Dr. Bills for doctors who making billing MSP more efficiently. So this is just part of it that is focused on healthcare. We have many other partners that is beyond banking that obviously partner with. I didn't show it here, but yeah, this is just focusing on healthcare. And that's all I want to share. Any questions? Yes.
How early into the process, if you have somebody who's like buying a clinic or looking to like rent a space, how early ahead of time do you need to get involved to provide them with financing?
I would say at this time, the more time, the better, because it will not give the time. If the time is short, then it gives pressure to everybody, right? And if we have all the information we have, I think give it 4 weeks at least. Yeah, sometimes shorter. I did those within 3 days that I have done, but it's really, really short, really, really urgent. We don't try to do that every time because I won't survive right, for that. But then I think 3-4 weeks at least it's a better time.
Like before closing?
Before closing.
It's pretty quick.
Yeah, and then it all depends on how big, how complicated the deal is too. Sometimes we have to ask the client to extend, if it's a real estate, extend the closing date. But for share purchase or that, usually if you do have all the information that we need is provided to me, then I can give it the number pretty quick and then send it to our financing specialist who to do. Sometimes I do it myself, sometimes the financial specialist I work with her to do it together. And yeah, if it is straightforward, it's pretty fast. Yeah. Mm-hmm. And that's just come back, and then other risk consideration from our risk team, then we'll have to go back. Usually, right now, I can share something is if you're a startup, like as a doctor, you're a startup, or say dentist, you're a startup, building our practice, and if you wanna also buy a real estate at the same time, that loan will be much larger, and the risk will be much higher. In that case, we'll need more time to to structure, and sometimes we submit, of course, we aim for 100%, go to our risk team, and they might come back saying that the projection needs to be adjusted, and that kind of go back and forth, that take more time. Right? So that's just something that we see right now. Yeah, I think it's competition is getting more intense right now. Depends on where your location is. Yeah. So hopefully we can help support as many as healthcare professionals as possible to grow the business. And for doctors especially, if they open a practice, they can help more patients. So there's a way that we help to create more opportunity for doctors to help patients. Yeah. Right, that's all I want to share.
Cool, that's very
Thank
good.
you.
Thank you very much, Nicole. Yeah, so today really the focus is on raising capital. So that's an amazing foundation for us. Thank you from a technical perspective. So again, what we wanted to do today is we're going to have a series of seminars. And it's meant to be more a discussion than a seminar outright. But today really we're focused on the capital raising. And then we'll focus more on real estate investing, focus on tax. But that doesn't mean today we can't get into some of those topics more specifically, like the tax and all that kind of stuff. But yeah, that was really good. Thank you for getting that foundation for us. So I'm gonna start with a bit of analogy, and I'm gonna keep hammering on this one analogy, so you'll have to pardon me for that one. So this is, you're probably already familiar with this, the elephant analogy. So there's a bunch of blind people, and they're all touching an elephant. One's touching the trunk, and they say, oh, well, an elephant is kind of cylindrical. And the other one is touching the side of it. Oh, yeah, an elephant is actually a wall. So everybody's got a different perspective depending where they are on the elephant specifically. So that kind of relates to the different financial professionals that you deal with in your life and how they kind of see your situation differently and are able to bring different things to the table. So that's why we have at least 3 of us here today, because we want to provide you with different perspectives. So we're going to look at some doctor situations and really kind of slow down a little bit and just kind of talk about those situations and what kind of opportunities we see there. So, the doctor's journey to capital access. So, as doctors, we understand that if we have a very simple problem, so this person, they've just got a cold or the flu or something like that, if I have that kind of simple problem, I can go to a general practitioner and they can take care of me. And I'm going to be okay at the end of that. However, if I have a very difficult problem, so I guess you'd call this a complex fracture or something like that. If I have a really difficult problem, I'm probably going to have to see a number of specialists. So this person, they've got their broken arm, they're going to go to emergency potentially, and they're going to get a cast on their arm. And then they're going to get an x-ray from an x-ray technician. Then maybe they're going to need surgery. So they're going to see the anesthesiologist and the surgeon who's going to work on putting steel in their arm. And then they're going to have to go see the physiotherapist. So the original one, simple problem, just see one person, you're done. If you've got something really complex, you're going to have to see a team of people because nobody's got the expertise that they need. All that stuff that April was talking to me about, sure, I have a baseline understanding, but I wouldn't be able to implement those kind of loans for people, right? So, same thing. So when we look at our financial world, a lot of people think they've kind of got a simple situation. Maybe that situation isn't quite as simple as they think. If it is simple, then they can probably just see one person. They can probably just talk to their accountant or go to their bank, and they can get everything sorted out for them. But if you're dealing, again, with a more complex situation, like the surgeon, maybe they've got a holding company and they've got an operating company and they've got a few different practices that they're looking after. Maybe they're pulling in $5 million a year into the corporation and they're figuring out, okay, these are my expenses, these are my staff, and they've got a lot of things going on, so they're gonna need a team to be able to look after them. So in this case, we've got the commercial loans. April would be able to take care of something like that. Potentially got an accountant, probably got someone like me doing the financial planning. We've got someone like Brian doing the specialized lending. And then we've got asset management, which might be somebody like Emma in the back. So you're gonna need a team of people with their specialties to be able to put the whole picture together in any kind of comprehensive way. So the kind of vicious circle is if we have those solo efforts where only one person is looking after you, you go in with your goal, you see that one kind of financial professional, and that financial professional, just like those people on the elephant, will see your problem as akin to something that they've got the hammer for, right? So your problem is a nail, they've got the hammer, no matter what your problem is. Not to say that they won't help you at all, but they may not see the whole picture on how to help out, right? So the doctor feels taken care of, but misses out on those financial opportunities. So how does that look in real life? So the doctor has $250,000 in retained earnings a year. So we're just saying that at the end of the year, that's the profits that he has left after all the expenses. So they're just starting their practice and they've got decades ahead of them. So they really want to grow. They're aggressive. They want to build a big business. So the solution that they get, so this one just goes to the bank, and probably not someone quite as skilled as April, and they get a $1 million line of credit, and they get some mutual funds. So that seems pretty good because they've got their $1 million line of credit, so they can buy some equipment, maybe they can lease their space, there's a bunch of other things that they might want to do with that money. And then they know that they're starting to build for their financial future, saving that $250,000 a year into their mutual fund. So what is the situation after 4 years? So they've got $1 million invested in the mutual funds because they had that $250,000 a year going in for those 4 years. They've been able to access that line of credit, and they're continuing their contributions to the mutual fund. So seems pretty good on the surface. They've managed to start their business pretty healthy, $1 million, and they've got some mutual funds working for them. But so the line of credit at this point, we've run out of our line of credit. Again, people might say that you've got access to more credit, but just kind of on a very basic level, you've run out of your line of credit. So you only were able to put $1 million into your business. Maybe you wanted to buy multiple practices, but you just kind of bought the one because you had that access to $1 million. And you have a heavy tax burden because a mutual fund is now spitting out a bunch of returns that you have to pay the tax on. And maybe you don't have a lot of expenses from the way you've structured this to be able to write off in the business. So what could he have done if he really had a team? So the accountant could have put together a good tax structure, so it would be more efficient. The CFP or even the asset manager could have put into some kind of assets that are a little more collateralizable. So somebody like Brian would be able to give them more access to capital. So they could now deal with April and they could deal with Brian, and they could increase the access to capital that they've got. And then maybe as they grow that capital and they grow more businesses, they can go back to April again, and they've got future borrowing opportunities because they've got a better looking financial statement at that time. So I could open it up now if anybody's got any questions, or I can go on to Dr. B and we can kind of see the change that is possible. Maybe I'm missing some things from your perspectives at this point.
What that specialized lending would be? Access to capital specialized lending? That's Brian's part?
So, probably I would say, of course, keep mentioning that Brian can do something. So I'm not a magician, so I can't.
Yeah. Pull your rabbit out of your hat.
So what I specialized in is insurance lending. So based on this doctor's scenario where the doctors just keep putting money aside in the mutual funds, right? At the same time, ranking up the borrowing on the line of credit as he do his or running his practice. Where I can come in is that we can actually build something that he can actually borrow against insurance. So which means when you have an insurance, what that does is it covers the loan or the asset or net worth of the business itself, right? But without having that, he will only have, I am pretty sure Carl will go over for the next option or the scenario that we're going to go over. But in this case, he will just have $1 million asset, $1 million loan at the moment. But where I can come in is that I can structure in different ways so that it is not everything that he will have after 4 years. There will be something more that he will have.
Yep.
So which I'll
Something
pass it on to
more,
Carl
yeah.
now that
Tee
you're
me
going
up.
to show us.
Yeah. Yeah, so that might be not completely clear at this point, but it will get more clear as we go through. And we'll get Brian back on stage again. So now we're looking at a more complex strategy. So now we're starting to get more professionals in the room, people working together. How can we make it work for that person? So same kind of situation that they're starting with. So now it's a little bit different. Now, again, we've gone to April and we've got our line of credit. And now we put in that insurance plan that Brian was talking about. So now we have a collateralizable asset, much like property or cash or something like that. We can get 100% collateral or 100% lending against it. So now instead of the money that was going into the mutual fund and just kind of stopping there, we're putting the money into an insurance product that acts like a mutual fund, and then through people like Brian, we're able to borrow 100% of that out again, and now put that money into our practice, real estate, investments, whatever we decide to do. But in this case, it's into the practice, because we're focused on accessing capital to grow the business. So that's number 3. Brian took care of that. And then the accountant can work with us to make sure that the tax structure makes sense, that we're putting all of the assets in the right place. It's going in the holding company, going in the operating company. We're doing the tax write-offs properly and all that kind of thing. So we can collaborate together to make sure that all makes sense. So after 4 years, now they put the $1 million into the collateral asset. They still have the line of credit, so that's the same as what we had before, more or less, with the mutual funds and the line of credit. But now we've got access to that $2.5 million that we're putting in over the next 10 years. So we're going to be able to continue to grow the business from here. Dr. A has kind of stopped growing the business because the line of credit ran out. So now that Dr. A was just making the contributions into the mutual funds. Excuse me. But now what we're doing is we're continuing with those contributions like before, but we keep on borrowing against it to grow the business over time. And then we're getting the tax savings from doing that too. So as a result, Dr. B has the long-term liquidity that they need to build the business. through the specialized lender, they've got that $250,000 coming out every year. Through the commercial banker, we got everything set up with the $1 million line of credit, and potentially April can do more things at that point. And then the accountant's been working with the whole team and making sure that they're getting all the write-offs that come out of this strategy. Yeah, so maybe we could, because I think I just put a whole bunch of information on everybody. We could potentially kind of pick that apart a little bit and go into a little more detail on how all that works. I don't know whether you guys have some questions right now, or we could just kind of go into explaining. If everybody's fine, we could just kind of continue.
So maybe I can elaborate a little more on the side where what it means by collateral, like it's asset that can be collateralized. So I think we're but we're just to give you an overview of the whole picture, A and B type, right? So when we're mentioning about asset that can be collateralized, as an example of Dr. A, where he just puts his retained earning directly into purchasing a mutual funds, right? What happens with that money is that once you purchase it, obviously mutual funds will grow over a period of time. As Carl mentioned, that there will be tax implication of that money growing over a period of time once the access to the capital that is grown over a period of time, right? Whereas we're as a group of specialists, we're trying to structure something better than just putting injecting the retained earnings straight into the mutual funds. We may be able to have money purchasing the insurance coverage, covering the business itself, at the same time growing what we call the cash surrender value. So there is a product, I don't know whether you guys already know over it, and I'm not the expert of it, but the whole life policy, let's say, to cover the asset or the net worth of the business itself. What we can do is we can lend against that policy, which means once the client actually used that $250,000 to purchase the policy, we can actually lend that money right back to the client, which means the client can use that borrowed money to invest in mutual funds, let's say. And now it's not that he only has mutual funds of $250 or the next 4 years it's $1 million. He has or she has cash surrender value growing within the policy, which means it's now he used $250,000 one time or two times to invest in two different vehicles. So over the years, the CSV will grow exponentially, right? Based on the insurance company's dividend scale. At the same time, this individual will have the 250 times whatever the number of years within the mutual funds portfolio. At the same time, now we think about it's borrowed funds. So the client actually borrowed funds from the insurance and invested into it. What happens when you use the borrowed funds to purchase mutual funds? Obviously, there is a certain other caveat to it. The interest could be tax deductible as well too. So it's not just only growing the asset within the one vehicle. We're now thinking about growing the asset within two different vehicles at the same time, implying the tax benefit of it too. So that was just to simplify what it meant by Dr. A and B difference.
Yeah, that's very helpful. Thank you.
I have a question.
Sure.
So when we're doing this type of structure, do you require the life insurance to be assigned to you guys?
No, so we're not, Equitable Bank is not an insurance company, but the client can choose to go with whoever they wish to go with, obviously working with the financial planners. Just that specific product is the key. So there are multiple different type of insurance products out there.
Yeah,
But there
so
are
say if they
specific
have a
ones, right?
Manulife life insurance and
Exactly.
they want to do whatever, with the solution that you were providing,
Exactly.
do you require them to have that insurance assigned to
Oh,
the
assigned to,
Bank?
yeah, exactly, yeah.
You
So
have
just like the property, when you're leveraging your property to borrow money against it, right? What happens if the lender will lien against the property, just like that we assign the policy.
When you lend, what is the percentages average? Just
So
to get a
what we call the immediate financing arrangement,
Mhm.
which is premium financing. So we go up to 100% of the premium. So if it is 250,000, then we lend back 250,000.
You need to have the cash flow for that.
We do look at the corporate cash flow to qualify because it's lending facility, right? But at the same time, we see the liquid asset of the client in between personal and business as well too. So we're not only just looking at the business cash flow, we look at the cash flow of the personal as well, because as April mentioned about the corporate lending, there are certain things, GSA or cross guarantee or the personal guarantee involved with it. For us, we only take the personal guarantee. So which means it really helps the business owners or professionals to lend more on the side for their own practice while they are growing their assets, borrowing against their asset that they can collateralize.
You said their interest rate could be.
It could be tax deductible.
And what is the defined number? Could
So definition of tax deductibility on the insurance would be more of the accountant expertise, but just based on my shallow knowledge, if you borrow and invest into an investment that generates income, it could be tax deductible, right? Yeah.
It needs to be either interest income or dividend income. Cover bank doesn't.
So it's like buying property and then renting it out.
Or,
Yeah.
or
investment
dividend
that is
share.
dividend shares that comes with the monthly income
Stocks.
basis. Yeah.
The other component could be a business component.
Yeah.
So if you use it for business operations also, it would be tax deductible.
Exactly. Depending on, like, let's say for example, if you incorporate this strategy for your business, and then if you use the borrowed funds to purchase equipment, right? That equipment, the interest will be then tax deductible because it was used to grow the business.
Also, the equipment will also have depreciated value over time too.
So yeah, what do you call it? There is another tax benefit to it.
Okay.
So underlying assumption with all this is that the ROI, return on investment for mutual fund or whatever investment, is greater than the cost of borrowing against.
Exactly. At the
So
same time,
historically, has that always been the case?
so our rate offers usually linked to prime. So similar to any other lenders out there, especially when it comes to the commercial. Historically, I do see, depending on what type of investment you're investing into, right? It could be in real estate, then obviously the outcome will be different. But we're not only looking at the whether we're beating the rate of return of the investment that the individual is actually invested into it, but when we're looking at the cash surrender value. So maybe you can kind of jump in to explain the cash surrender value will go over, let's say, 10, 20, 30 years of the whole life participating policy.
Yeah, so generally speaking, what we've seen is a correlation between interest rates and the dividends that something like a life insurance policy would generate. So there is a correlation, and generally over time, it's about a 2% spread between the prime rate and the dividend that you get from the policy. But in order to get that spread, you don't exactly need the rate of return on the policy to be higher than the interest rate, because the interest is tax deductible. So that somewhat brings the net cost of borrowing down, and the return on the policy is tax-free or tax-deferred. So
it's
as a
all
result,
about the tax.
Yeah, it's all about tax.
Tax deductibility.
And once
you're just
again,
playing the
it
tax.
shouldn't be a short-term strategy. In order to really gain the benefit out of this strategy, it has to be more than 10, 15, or 20 years. Because once again, we're looking from our perspective when we are lending out the money, we would see roughly about anywhere between 5 to 6 years aggregated loan amount to be less than the CSB value. So that's the break-even point for us to have 100% collateral, right? So which means from that moment until they actually realize the gain of the CSB and then pay off the loan, that will be could be much more than just a simple rate of return.
Mm-hmm. Yeah, because as you kind of outlined, paying the interest on the loan is a simple rate of return, and what you're getting on the policy is a compound rate of return. So it's a bit cheeky maybe in kind of presenting that as a benefit, but it does work out that way, that this will be growing at a compound rate while you'll be keeping the size of the loan where it is.
But at the same time, it's not just of the opening up the opportunity to invest in the different vehicles, but at the same time for the business owners or practitioners, it's just that freeing up the cash flow while they still invest into something, right? Because let's say you just invested into mutual funds, just like the Dr. A. Later on, if they max out their line of credit, once again, where should they go? They need to redeem the mutual funds. And what happens when you tax event happens, right? When you have this strategy involved with the practice itself, then you have a lending facility that where you can, if you haven't actually used it to invest in something else, you have this facility available for you to use for that needs of the cash flow.
Basically, use just one capital but leverage twice.
Exactly.
Yeah, I forget the term of it, but the opposite of a vicious cycle is kind of the way that I see it.
Right. Yeah.
That basically what we can start doing is kind of putting the money in, getting that borrowing from, well, first start with April and get the line of credit, put the money into this asset, get the money out through Brian, and then build the asset, which is now the business, and then go back to April and say, okay, I've built the business larger. Is there anything else I can do? Oh, sure, there's something you can do. And then go back to Brian, build it again, and you can kind of go cycle through the two of them, right? Borrow more money here, borrow the money there, borrow, and just be the biggest business in Canada at some point.
So Brian, you talked about the guarantee, how you guys don't need GSA, you probably won't need corporate guarantee either, just personal guarantees.
Just
like
personal
your personal guarantees are also different from like if I got a mortgage and they put a guarantee, it's gonna show my bureau. Can you talk a little bit more about your guys' guarantee?
Sure. Yeah. I mean, obviously, when you apply for whether it's for the corporation or for yourself, you probably know better. There is a section where usually asked, have you co-signed a loan, or do you have any guarantee on any other businesses? So it's more on the basis of the disclosure, right? From our end, when we take the guarantee for the business, let's say immediate financing arrangement, we do not actually report back to a credit agency, which means it will not show. But obviously, we're kind of giving that back to the client who's applying for another credit, that it is on them to whether to disclose that information or not. But it will not show on the credit bureau. But it doesn't mean that there is less risk for the client or whatnot. The main thing that I want to mention too is that when it comes to the commercial lending, especially if you're trying to increase the borrowing for the business, whether it's a physician or any other businesses, GSA is the main thing. If you already have GSA lean against the business itself, it's somewhat difficult to borrow from another source. Whereas because we don't go second, we don't go first, we don't ask for it, it is simpler, I would say, to process the lending, because our biggest collateral is the insurance itself. And because the fact that the insurance is cash surrender value, unlike any other assets, maybe not, but let's say I'm comparing the real estate. Real estate could depreciate over the period of time, whereas CSV value will not, it will only go up. So we know the strength of the collateral itself, so that's why we're big bold on not taking any other guarantees other than personal guarantee.
The reason the two of you kind of complement each other, because you're not going to restrict lending that we can now get from April. Yeah, so we'll get back. Any other questions? Anybody want to discuss any more about that?
Now, the insurance policy needs to be held within the business name, not the personal name, in order for the store.
For the corporate borrowing, yes, it has to be under the business. We do take the personal guarantee, but always depending on the purpose of the insurance policy, right? It could be under the OCO or HOLCO, depending on the plan that they have.
Yeah, 99% of the time it's within the HOLCO. Yeah.
Right.
So So we look at the difference. So Dr. A, again, he maxed his line of credit. And so he's no longer investing into the business. He's just putting that money into the mutual funds after 4 years. So as a result, he doesn't end up with a lot of liquidity and not a lot of estate at the end. And then Dr. B, they have the $2.5 million in the policy. They've drawn all that out plus the line of credit. So there's been another $1.5 million that's gone into growing their business. And as a result, probably we see more business growth as a result of that. And they've now got the estate that's preserved for them.
Mm-hmm.
And the estate is also going to be, to a certain extent, tax exempt because the policy is going to create a capital dividend at the end of the life.
If they're loaning against their life insurance policy, they're like depreciating the overall policy value, right?
No, because they're not actually taking the money out, they're just borrowing against it. So there's no effect specifically on the policy. It's just like a
Because you're
mirror.
putting in a certain amount of money though, right? If you take
So they're
loan back against
obviously-
that, you're losing part of it until you add that money in additionally over time. So you have a minimum contribution to hold your life, right?
You would have a minimum contribution that you're putting in every year, yeah, which is the $250,000. So
two parts, right? Death guarantee, right? Guarantee or death benefit, and then there is the cash surrender value, and then we're only interested in cash surrender value. So your overall set death benefit for the policy will not be affected at all. The payout will be the same. It's just that the investment portion of that insurance will be affected by the loan.
There's no repayment terms for.
It's open term.
You don't lose part of the death benefit even if you loaned in theory half of what you.
So that's why, look, so let's say if the death benefit, I don't know how much it'd be based on the 250,000 premium, just roughly
the
guess.
face value will be
Okay.
about 2.5 million.
So 2.5 million death benefit, right? So CSB will grow differently from that. So there will be another portion of it, right? So let's say the loan value ended up being, say, $2.5 million for this strategy, and the CSB value is, let's say, just a little shy of 2.5 by the time. Obviously, the death benefit will stay at 2.5. What will happen is we will use the cash surrender value to pay down the loan that we have. Any difference will be guaranteed by the person, right? The owner, the policy owner himself or herself. So we'll have a recourse of getting that money, but once again, it will not really impact the death benefit part of that policy.
But your deal is still valid because eventually the death benefit will be used to pay off the loan.
Right. If you're
You can pay off the loan anytime.
anytime, yeah, anytime. It doesn't have to be the full amount. It could be a lump sum, it could be a portion of it, and then you can re-borrow it as well.
And if you're not paying off it, just sitting there, it's not, there's no repayment schedule.
No, nothing scheduled as long as there is the minimum
Should be
interest payment.
paid interest.
So again, we look at the difference between the two. So this is kind of by the end. Dr. A may need to sell the clinic for the end of their lives to settle up the estate. Had a lot of tax inefficiencies and didn't really have that kind of passive estate growth over time. Dr. B had the tax-free growth. The capital dividend was available to them at the end, so all the money came through, or at least a lot of money came through to their beneficiaries. And they had different options that they could have used for retirement or whatever with the immediate financing arrangement. So that's kind of the difference between the two doctors. So the way that I kind of see it is that this doctor has taken advantage of a lot more capital. So I was kind of mentioning before, between Brian and April, they've had access to kind of potentially exponentially more capital just because they've been able to play the two off each other. Grow the business using the policy, grow the policy using the business. So Dr. B's a lot better off because they used a team and everybody collaborated together, which is kind of similar to what you would see, I think, in the medical field. A lot of specialists interacting and making sure that they communicated well and kind of implemented everything together in fixing a person's arm.
Mm-hmm.
So that's the whole thing. So we can have a more open discussion. I know we've kind of already had that already, but if anybody has any other questions, we can go into other areas potentially too, into investments or tax or corporate structure.
My recommendation is that maybe if you do a scenario where you had, $2.5 million or $250,000 policy, and just do the numbers, and then the Dr. B going into an investment, and that might be real estate, it might be a mutual fund, whatever, another investment vehicle, and then seeing over a lifespan of 10 years, maybe 20 years, to see what position Dr. B would be in compared to Dr. A. Because at the end of the day, for me, it's like I like seeing the numbers and stats, and so that will get me to understand. Okay, well, obviously, B is the option. I mean, B is the decision that you should go with. But then I would like to know what the numbers are, because then I'm an investor, so I like to look at real estate. And I'm like, okay, well, if I hold a property for another commercial property that I bought with the additional funds, we can look at the appreciated value of a property over the next 25 years, and then how big my portfolio of real estate would be. Option B than option A.
I did do all those numbers,
Okay.
so I have them all on spreadsheets,
Yeah,
but I thought it was just too much to go through a bunch of numbers.
For me, that's what actually I prefer that, because I'm a numbers guy, so I like to see the numbers,
So
and then I'm like, I'll at 20 years I'll come out with a $15-20 million portfolio. With option A, I come up with my policy, wherever it is.
Yeah.
So that's how
Do a one-on-one meeting. Tailored for you.
Well, the funny thing is, when you look at the mutual fund net rate of return, it's going to be similar to the insurance rate of return.
Yeah.
Because the insurance rate of return is tax deferred.
Yeah.
And call it between 4 to 6%.
Yeah.
And if you look at a mutual fund, maybe you're kind of being a little generous, but you look at a mutual fund, maybe you're looking at a 5 to 7 or 5 to 8% rate of return.
Yeah.
But there's going to be tax on that, right?
Yeah.
So the growth rate should be a similar growth rate, but you've had access to that liquidity for all that time that you've been able to do other things with. And if you look at probably the growth on the business, maybe you're using a 10 to 15% rate, which is also tax advantaged if you're growing the business.
Yeah.
So those are the kind of rates that would kind of come out of this. But yeah, I could definitely share the spreadsheet with you that I use for this presentation.
Perfect.
But yeah, if you look at the retirement income, it's about $60,000 that you should be able to pull on the mutual funds, and it's about $200,000 that you should be able to continue to pull. Because with the IFA, Brian didn't kind of the immediate financing arrangement, the ability to put it into the insurance and borrow out again. You can do that once when you're building the policy to begin with in the first 10 years and use that for potentially growing the business. Then you can kind of wait 10 years and then you can borrow against it again because there should be extra equity. So that can fund your retirement income also.
Right.
But yeah, I have all the numbers, so I can share them.
Can we talk a little bit about corporate structuring?
Yeah.
Suggest?
There might be some limitations on my knowledge, but we'll definitely talk some basics. So you're just kind of wondering what a normal we've got you, right?
Just realized.
Yes, you're well prepared.
I'll just sit down.
Here comes the bus.
I haven't done a lot of whole life assignment stuff, so I can't speak to that too much. But what kind of stuff are you asking about?
The structure for corporation.
Just kind of
Is there-
general
yeah,
information about corporate structure.
What is the beneficial one
Yeah, so the typical spiel that I'll give when I talk to people, I'll talk to clients, is that the two benefits you get are liability and tax. The easy way out for me is when I say tax, I just say go talk to an accountant or a financial planner, and they'll be able to put you in the right direction. But I suppose general rule of thumb is that you'll want to have an operating company that you're operating out of if you're a practitioner, because you want to be able to be running your clinic and holding all of your liability there. Say, I don't know, if you're a plastic surgeon and you give me a nose that I hate and I sue you, all of that liability would just be held in your operating company. But if you have a holding company as well, you can be drawing out any money that you don't need for operations or any profits that you get back to your holding company. So say you make $200,000 in a year, you only need $100,000 to operate. So that would include like any payments you need to make towards release or employees or anything like that. You can use that $100,000, keep that in your operating company to pay out all your expenses. The $100K that's extra, you can pay out to your holding company as dividends that you can then use to like purchase real estate, hold any other investments, pay yourself, do whatever you'd like. And I suppose probably do something involving a whole life policy. But again, I've only ever like heard these in presentations. I haven't seen it in practice. Again, the benefit of doing that as opposed to just having your operating company is that if you held all your money in your operating company and you're making investments, again, if you give me that botch nose job and I come sue you, all of a sudden your house or your investments or anything that's in the operating company is up for grabs. So if you're paying yourself regularly or holding company out regularly, then the benefit of that is that if I come after your operating company, there's a lot less assets that are in there, and all of the assets are safe in your holding company. That you can, depending on how you want to structure your life, you could have other companies that you're investing in through your holding company. You could have multiple clinics, each with their own operating company, all tying back to the overall holding company, all that sort of jazz. So that's from a liability perspective, it's advantageous to have at least two. Tax-wise,
The college, I think they only let you have one.
yeah, so you'd probably have,
You mean the rival college? Yeah, college associations, I think.
You have your professional court.
Yeah.
Yeah.
But you
So
have you
that's-
can have your holding company because we see many clients they have professional court. Yeah, professional only for operating or if your practice, right? And then holding companies for like the asset accumulation. Well, both that will be in the holding. A lot of people would, I think, maybe pay dividend from the operating to the holding, right? And talk to the accountant. They have more strategy on how the wealth should be transferred. But then we don't. Right, so if for the operating holding, the bank doesn't like to see, say you're buying an investment residential 1 unit condo under your operating company, we don't really like to see that because it kind of mixes up things, right? And then you're right, for the legal perspective, you've got some legal situation that property is up against, so they will chase after, have the chance to claim that property, right? So, and I'm not sure if the college will agree for having that type of investment in the operating company either.
Yeah, that tends to be held in a whole company.
Yeah, usually it's under the holding company. All the asset, or the real estate especially, will be in the holding company.
yeah, the general rule of thumb, which like you guys can confirm, because again, we always caveat with like, you should talk to an accountant after or someone with money.
Yeah, we want to say that.
It all comes down to accounting.
Yeah, does anybody need an accountant?
And the accountant don't actually know about it.
Yeah.
That's true.
Some doesn't, you know, right?
Yeah, really.
Is that as soon as you start making more money than you need to like exist, whether that's your business needing more than your business needs to exist or yourself needs to exist, then you can incorporate a holding company as well, because you can enjoy all those benefits. If, like, for example, I, as a lawyer, I'm making like all of my salaries to pay off my loans and to like exist. When I start making more money than I need, I can incorporate an operating, or I can incorporate a company that I'm going to operate through, and then I can park some money in there.
For the personal level types.
Exactly, yeah. If you if you think about that, is you're already having an operating company that you're going to practice through as a doctor or a medical practitioner. When you start making more money than you need to have in your business, you can have that holding company that you can transfer wealth out of, and then you can have a trust that holds shares in it. And depending on how you want to structure your life, you can have a ton of different options available to you. That like you're kind of playing with like partially pre-tax money through the holding company, as opposed to like having it all come to you and then having it all taxed at your personal income tax rate, which would be a lot less you're playing with.
And defer that.
Yeah.
Basically till death, and then the whole life insurance
And
take
then-
money out tax free.
Then your kids can fight over it.
Or he for them.
I can contribute a little bit more there. I think the question traditionally would have been interpreted as what kind of share structure can I have to split income? But that's mostly done away with.
Yeah, it's a little more
Right.
difficult nowadays.
Yeah. But borrowing away from, I'm a business lawyer as well. Borrowing away from Subway for business, for example. Their head office has so many companies. One company owns the trademark, one company owns the handles leasing, employment or HR and so on. So I can see if you're making too much money, then you can have one company leasing your equipment, furniture, and so on. And you can have one company handling your HR. Appoint yourself as a manager of HR and source that out. There are many ways to do it because it's about handling your ongoing liability as operations. You can if you get attacked on one area of your practice, you can isolate that, you can limit that. But the other side of that ownership is right to dispose. So if you want to grow something and it comes to value and you're able to sell something, by selling it as shares, you can access the lifetime capital gains exemption as well. For having two locations, I mean, you can have leasing companies separately as head tenants, so it limits the cross liability. But those companies retain your professional company as a doctor to operate, work out of there. So there are many ways to design this.
Yeah, it's all gonna depend on the specific situation, I guess.
Yeah, I noticed that you elephant, you're missing a lawyer there.
Oh, yeah.
We have two lawyers in the room.
You're hired.
Yeah, they're done. They show up at everything. You can just count on them to be here.
So Michael, you deal with broker businesses as well right now. Like, what are you seeing in terms of, are there a lot of people selling their businesses like because they need the money for retirement, or generally do you see people like, hey, we got a good financial, like a retirement plan in place. I don't need to sell a business if I don't want to.
Lovely segue to my question, but yeah, when you sell business, when people are selling their business, there's reason why they're selling it. And of course, majority of it, we're getting old. We can't avoid that. So succession planning is a major part of it. Right. Otherwise, the rest of them, you have to really figure out why are they selling, because it must be, is it personal or is it a business problem? But the segue was this, you talked about this is long-term gain, right? Long-term, right? But I'm thinking about a typical doctor who went to doctor school, and this, by the way, should be part of the graduation class ceremony. Just like kids high school need to learn how to manage their finance, this is really valuable. I hope you can get it in there.
Yeah.
But there are typical doctors like lawyers who spend 30 years just blinders on practicing medicine, and then suddenly realize that 5 years before retirement, holy shit, I haven't done enough to do this. So is there a playbook for a short-term gain?
There's a playbook. Short term goes down to about 5 years.
Yeah.
And then below 5 years, it's not a lot we can do. But if we have 5 years, we can definitely do something.
That's a topic for another seminar perhaps, but I think
Yeah.
there's just as many interested audience there
Mm-hmm.
than those young doctors who are going out there
Yeah, I'm in that boat
Mm.
with you.
Nearing retirement.
Yeah, then just realize, wow.
Yeah.
Life happens, some of them go through divorce and so on.
Yeah, so there are potentially things that we can do, especially with a holding company, if somebody doesn't have the 5 years, but 5 years is kind of like a golden figure for putting a strategy like this in place. Always better if you have 10 and 15, but we can do those kind of short-term plans.
The good thing is everybody thinks they have 5 years.
Yeah, exactly. Yeah. I guess it's the doctors that can tell us otherwise.
I have actually worked with a client who is 74, took out a whole life policy because the estate is just big enough to do that.
Yeah, I've seen cases
Yeah.
where clients in 70s starting putting quite sizable premiums
Yeah.
because of the fact that they have really sizable
Yeah.
estate that they're thinking about it. I mean, still, it's not too late in the game, but it is doable, as Carl mentioned.
Yeah.
We see time to time. But obviously, our goal is, as a financial planner or helping out the clients, that we want them to really, realize that the importance of actually actioning on the plan that they have early
Yeah.
in their lifetime.
Mhm. Yeah, and it depends what you're doing it for. If it's an estate reason, then we've got a lot more flexibility. But if it's something like retirement, then we don't quite have as much flexibility.
Thank you. Well, thank you guys for coming out.
Yeah, thank
Thank
you.
you.